Let's talk about REITs versus real estate investing. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as terrific as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about REITs versus real estate investing versus property investing. Many investors recognize that it's important to diversify their investments and include different types of assets, right? I'm talking about stocks, bonds, alternatives, real estate, commodities, and so on and so forth. Consequently, the idea of including real estate in an investment portfolio comes up, right? Now, if you are an investor out there listening to me, there are two main ways to include real estate in a portfolio. In your portfolio, you can go through REITs or direct investment in real property. In other words, you go and buy a house or a condo or a villa or a vacation villa, whatever it is, you're investing in the real property. So that's either that or you buy a REITs. Let's talk about REITs. What are REITs? Actually, by the way, we have covered the subject of REITs investment in another show, like more deeply. So you might want to double check that show and get more info. But I'm just going to quickly get into the nitty gritty here. What are REITs? Real estate investment trust, aka REITs. They are treated like stocks on the market. So they are collections of real estate related assets. So they might include residential, commercial, industrial, or agricultural real estate. So some REITs include storage units or mortgages or malls or a mix of investment. You have a different asset classes out there when it comes to REITs. So the idea is that if you have exposure to real estate without actually owning directly or indirectly the property. So this conversation here is about whether REITs actually represent owning real estate rather than just owning a stock. It's not for today's conversation. So REITs are treated on a public stock exchange like the New York Stock Exchange. So for those who want exposure to real estate but don't have the capital for direct investments, REITs can be a reasonable choice for a financial plan. Some companies allow you to start investing with as little as $1,000. There are REITs that provide you with the ability to diversify across property type, geographic location, and more. And the great thing here is that there are REITs that pay dividends. So they can be included in an income portfolio. If your goal is to have income on a periodic basis, it might be great to add a REITs to your portfolio. Another thing that is another topic that's very important when it comes to REITs is the liquidity issue. And liquidity is a great issue, especially if your goal is to not only to generate income, you want to have a periodic income, but you also will use that income to reinvest in other asset classes or just go about your life. It is important. So because traded REITs, make sure you know the difference between traded and non-traded REITs, because the traded REITs are the ones that you have on the stock exchange, and non-traded REITs are those that are illiquid. In other words, they are more private, and you invest in them, and the funds are kind of locked for a period, and they kind of operate similarly to hedge funds. So traded REITs can be bought and sold like stocks, as I said earlier. They are fairly liquid, unlike direct real estate, which can be difficult to sell quickly if you decide you need to. However, at the same time, you do run the risk of losing quite a bit of money if the manager makes a poor decision or if some of what's in the REITs tanks. So the other aspect of REITs over owning real estate is taxes. So based upon the way they are taxed, REITs are best suited to be placed in retirement accounts. There is nothing preventing you from investing in REITs in taxable accounts though, but I just want to clarify that if you are concerned about taxes, if you want to optimize and minimize your tax bill, your tax debt, it's better to place your REITs, the REITs that you acquired, in a retirement account, such as an IRA, an individual retirement account, or a 401k. You need to have a tax sheltered account to be able to increase the return of a REIT. So when it comes to REIT investment, you got to think about liquidity. You got to think about your fiscal situation. You got to think about whether the REIT is the location, the sector, the type of REITs you're buying fits within your portfolio management, with your portfolio strategy, because it's all about diversifying your assets, diversifying your portfolio. So you got to make sure that if you, for instance, if you're already exposed to the healthcare industry by buying bonds or stocks, you don't want to buy a REIT that's also focused on the healthcare industry. You need to diversify. Don't put all your eggs in the same basket. So I've already talked to you. This is about investing in REITs. Let's now talk about real estate investing. So direct investment in real estate does have some advantages though. So if you can put down a decent down payment and you have the ability to manage the real estate effectively or hire someone else to manage it, direct rental property can be a great asset. By the way, if you don't make the full down payments, the 20% or 25%, depending upon your state, you will be charged with something called PMI. So this is an extra fee. PMI stands for Private Mortgage Insurance, and this is it ranges from 1% to 3% of the property value, and this is tacked onto the monthly mortgage you have to pay. So this is why it's very important before you get into the set of this kind of deal, if you want to own real estate, to save some cash so you have some money. It's usually best to think of owning a rental property as an investment and business. It's not truly passive compared to owning a REIT, but the amount of direct work can be minimized. So traditionally, when you own a property, you have more control over the investments, right? Besides, you have something physical to fall back on. Even if the market tanks and the property loses financial value, the fact that you still have a tangible asset that you could live in, or in the case of farmland, or use in some way remains. So as long as the property has tenants, you have a monthly source of income. On the downside though, directly owning real estate means you are responsible for it. What I mean here is that you are in charge of a lot of stuff. You need to address tenant problems. You have to deal with trying to collect rent. You need to choose tenants that are not going to destroy your property or rip you off. And one way to avoid this is to invest in land that is just sitting there and that you don't expect income from right away. As long as your financial position allows you to do so, this could be a great opportunity. So directly owning real estate has its pros and cons, and it's all about your financial situation and your personal situation. And this leads me to the final question. Which is better, REITs investing or real estate investing? This is a great question. So investing in REITs and direct investment in real estate both come with pros and cons. In the end, you have to weigh the options and decide which better fits your style. Some investors prefer a mix of REITs and directly owned real estate. In other words, so you're getting the best of both worlds. Other investors prefer one type over the other for whatever reason. So before you invest though, make sure you know what you're doing and understand the risks. As I said earlier, you have to think about liquidity. You got to think about, first of all, before we even think about liquidity, geography, and tax and your fiscal situation, you got to think about your financial goals. You need to think about your financial situation. Do you have enough liquidity? Do you have enough cash saved? Because whether or not you're getting into property management or property investment or owning a REIT, you got to have some cash on the side. We've had several discussions and several shows covering the fact that you need to have an emergency fund, that you need to have some another savings account, that you need to have a tax sheltered account such as an IRA or a 401k, a Roth IRA or a Roth 401k, doesn't matter. But you need to have this kind of a scheme in place. So real estate investing versus REITs investing, it all depends on you. But first, find out your financial situation, your financial goals, and then think about what is important for you. Is it liquidity? In other words, do you want to be able to sell and buy the property as much as often as you want? Is it fiscally your fiscal situation? Do you want to optimize how much tax you pay on the investments? And also, how quickly would you need the money? Thank you so much for today's conversation. I really appreciate it. I will see you next time. But until then, remember, stay marvelous.